Hey everyone, welcome to another deep dive. Today I have with me Luzius from Frankencoin. Great having you on.
Great to be on the show. Thanks.
Yeah, and this is, if you couldn't tell, this is Frankencoin. It's a special Halloween episode here of Deep Dives. But yeah, so would love to find out how did you kind of get into your Frankencoin is a stable coin. How did you kind of get into building stable coins?
So I met with the founder of Liquidity and was very impressed. So I think Liquidity is one of the best stablecoins out there because it's very robust, it's relatively simple, and it seems to work. And then I thought maybe it's possible to do better. And I was also in the process of doing a PhD, and I was looking for a topic that I could dive into. And then I thought, let's figure out if we can get rid of the oracle of the liquidity protocol, I would say. So the one weak spot, the Achilles heel of the liquidity protocol, is its dependency on the Chainlink oracle, which is an external dependency. And of course, it would be nice to figure out how can we do it without that. So I started to tinker with that, and I found a way to do it through an auction. And what's relatively new is that, so it's not the first coin that uses an auction mechanism to liquidate, but it also uses the auction mechanism to determine the price. So usually you have the price externally determined, and that triggers the auction, and then the collateral is sold off. So it's a collateralized stablecoin, I have to say. So if you know,
well, we can get into kind of drawing it out here in a sec.
Yeah. So that was the question. How did I get into it? It's through Liquidity essentially.
Yeah, and then do you stay in touch with the Liquidity guys?
Yes, they are also here in Zurich. So I meet them every now and then. They are also onto new things, very interesting what they are up to. So it's good to see that the ecosystem is developing.
Yeah, well, I just read, like, if you saw the V2 thing, they had like the Oracle report out from Liquidity. You should like ping them. You should be like, there's other options. You don't even need to use an Oracle. And it could be...
they cannot upgrade their protocol, and this is
right.
I think this is a good thing to be immutable, but of course it means that if you want to do something that is new or different, then you have to redeploy a new coin,
which I think is super cool. But yeah, let's kind of get into drawing it, and we can see. I'm gonna pin myself here. And by the way, Frankencoin is based. It's not actually a monster coin. It's the Swiss franc, right?
Yes, it's a reference to both to the Swiss franc as well to its self-governing nature.
All right. Okay. Well, let's I guess let's build this. This would be a smart contract on top of Ethereum or a similar EVM network, I'm guessing. And then the goal is to have the eventual goal of the system is you have a user who has a dollar or stable like instrument, right?
Yes. So the purpose is basically to do what the bank does, but without the bank, namely to create money. So in the traditional monetary system, if you have $100 or Swiss francs in your bank account, maybe 20% of that is through central bank money, or even less, that is backed by central bank deposits. And the other 80% is credit money that has been created through a mortgage, for example. And this, of course, you can also do in a decentralized way, like DAI or Liquidity does. You provide the collateral, and then you create a debt on top of that collateral. And if you design the protocol nicely, then you don't need the bank anymore to do that. So it's the big topic of blockchain technology, disintermediation. We can get rid of the banks to create our own money. So
right, well,
yes.
But the difference with like a Liquidity would be like it's 100% collateralized by something, right? Obviously.
Liquidity is also collateralized.
Yep.
Over collateralized. So there's, starting from Liquidity, the first thing I was thinking of was how could we be independent of the oracle, and then this automatically adds another feature, which is it's much more versatile because we don't depend on an oracle or an external market. We are very free with regards to the collateral that is acceptable. So in the Frankencoin system, anyone can propose a new type of collateral. So it's open to any ERC20 token. And then, of course, you need a governance process to say, is this an acceptable collateral, yes or no? So this leads then to the next thing. And here in the governance side, there is also some novelties in there that I looked into as part of my PhD. But I would say that the good starting point is the liquidation mechanism, because this is
well, let's start with how we get this system set up. So we would have, like, let's assume that there's only one type of collateral, just for ease.
Yes.
It would be what, ETH would probably be the easiest
example,
collateral,
or even liquid staked ETH, for whatever. So it's
sure. So you would have somebody, they would come in and they would deposit ETH, right?
Exactly.
They would deposit ETH because they're hoping that then somebody would want to come and borrow it and pay them an interest rate to do so, right?
No.
Okay.
Yes, already. So they would deposit ETH. It would be, they would also say when they do that, if they're not the first ones to do it, then they can copy another the data from another position that is established. But if they are the very first one who deposits a new collateral, has to say, I deposit this type of collateral and I say this is worth at least 1,000 Swiss francs per unit, and I want to borrow against that.
Worth 1,000. I don't even know what's the franc. We'll just use dollars.
Yes, you can use dollars.
The dollar symbol for francs, but per ETH. So you would basically say that this is what it's worth. Okay.
Yes, and of course you should go below the market price, because that's also level at which you get liquidated.
Oh, so
that's
this
the
is
liquidation price. So
yeah,
this is quite important. So in today's market, you could start with that. Today it's at 1,800 roughly, and then you would maybe say, I put the liquidation price there. You could also
so you set your own liquidation price when you're depositing.
Yes.
Okay. So you deposited it. We'll say the price is actually worth 1,800, but you deposited it and said it's only worth 1,000.
Exactly.
Okay, and then what happens in the system?
And then, so there's some, if it's a new type of collateral, there's some period, that an application period during which it can get rejected by the system. I would say we get to that later, but let's assume it goes through and the position is ready. We call this a position. In other systems, it's called vault or trove, or so. For us here, it's a position. And then you can start to use that to mint your Frankencoins. Let's say you deposit 50 ETH, then you would be able to mint up to 50,000 Frankencoins, or dollars in this case.
Yep. So then, and you would mint it back to yourself?
Yes. And when you do that, you don't get everything. So this is so it's an arrow that divides into 3. So maybe out of these 50,000, you might get, let's say, 39,000.
So you get 39K, okay.
And then there's 1K that goes away as a fee to the system. So there's always a fee that also serves as an interest. In this case, the interest would be 2% for whatever period this position is valid. So when you initiate the position, you also set the period. You say this expires in 1 year, or in 10 years, or in 2 weeks.
So when you mint, you say this expires in a year?
It's already when you deposit. It's
so when you
initiate it. So you say this expires in 1 year and the interest is 2%, for example. So these are important parameters because that determines the fee.
Okay, so you actually set all this when you're depositing, and then
yes.
All right, and then I guess I can ask later, but I'm guessing if it expires and everything's still out, it's like up for liquidation, right?
Exactly.
Yep. Okay, and then where does the other 10 go?
the other 10, so there's another parameter you have to specify, the last one, and this is how much should go into the reserve. So there's a minter's reserve. This is the money that you are at risk losing when you get liquidated. So these 10K go into a dedicated reserve that is assigned to you. And when you return the 40K that you owe the system, you also get this 10K back. So
Okay.
so that's basically what's at stake if you don't repay in time when the price falls, for example.
Nice. Okay, so now you have the system. Hopefully, assuming ETH is stable, you have it out for 6 months, a year, and then you can just give it back, right?
Exactly.
Okay, and that would work. But there's obviously, now let's talk, how do we make sure that this thing actually is worth $1 or 1 franc?
Yes.
And how does it get liquidated?
Yes, so let's say this position is established. It's correctly initialized with a good price at 1,000 per ETH. And now the market goes down again for whatever reason, and it goes down and goes below 1,000. Let's say its market price is at 980 or so.
Okay, so if market drops, say 980. Okay.
Now, the system provides an incentive for participants to challenge this position and to challenge it. So there's a new person that needs to come here. So they might have watched the price already. And so now is a good time.
So
and
he would call, what is it, challenge?
Yes. There's a function called launch challenge. And to do that, they need to put up some collateral themselves. So ideally, let's say for simplicity, it's the same amount. It's also 50 ETH that he provides to launch the challenge.
So he would have to match whatever he's challenging.
He could also do a fraction, but it makes it simpler to explain when it's the same amount.
Okay. Okay.
So, and that starts an auction. The auction price has so the auction has 2 phases. In phase 1, the price is flat at these $1,000. And this, depending on the collateral, this is also something you provide initially. What's a reasonable parameter for this type of collateral? If it's a highly liquid collateral, it should be a shorter period. If it's something very illiquid, then it should be a longer period. So here it might be 1 day because it's a very liquid collateral. So phase 1 is 1 day. And
so this is the parameters are set up probably when you set up
exactly
what collateral it is.
Yep. Exactly. So this is when you initiate this collateral for the first time. So, and if so, this is now up for sale by anyone. And so you might come here and say, markets went up again. Now it's 1,050 again. So I buy this for 1,000, and then you get it. You can buy this for 1,000. And in this case, in this phase, what you get is the collateral of the challenger.
Right.
And this is a very important twist. And in this case, what we call this, the challenge is averted. So the challenge basically failed because someone was willing to pay 1,000, which means the market value is at least that high.
Right.
And
well, is there a fee here too? Do you burn some?
No fee.
No fee. Okay.
It's just, I mean, the challenger risks something because if the price goes above 1,000 again, then he sells for too cheaply. He makes a small loss.
Right. Okay. Well, so, I'm just wondering, like, could, like on this position, like, could this guy be the same guy as far as like he could just like he could just keep like this is basically like an options contract in some way, right? So like he just always is challenging himself and then closing it out.
So there's countless different options how to try to cheat the system. And
Right.
this is something that we have hardened during 3 security audits. So
Okay.
it's I created the game theory behind it. So I looked at it from a theoretic perspective, but this is very abstract and entirely different beast from the actual implementation, because the actual implementation is always more hairy. You need to care of more details and so on. And but we hope that we have eliminated all potential edge cases how to manipulate this.
No, I love it. Anyway, I'll
So,
ask edge cases once you're done. We can continue. So after phase 1, so assuming nobody buys it, that would mean that the price is below 1,000.
yes.
And then
And
it goes into
a Dutch auction mode. So it goes in a Dutch auction where the price linearly declines to 0 also within 1 day.
Dutch auction. All right.
Yes. And now in phase 2, the bidders are bidding for the collateral of the borrower. So the owner of the position is now the one selling the collateral in this phase. And
So this would be the 39 and the 10. So it'd be this 49.
It would be the 50 that
50? Well,
50
1% was to
supply.
the, well, 1K
so
went to the system, right?
Yeah, but the auction, of course, is you're not bidding for Frankencoins, you're bidding for the collateral for the ETH.
Oh, okay.
So, and now an interesting question is, will the resulting price be above or below 800? Because this is where how much the reserve was, the 20%. So let's say.
Well, so you're bidding on his position?
Yes.
Okay, so if you buy the
not
50,000,
the whole position, not the whole position, but just the collateral, and then the proceeds, what you bid, this is used to repay the position. So, and there's a good case and a bad case. And the good case is, let's say the highest bid is 90. 900 per ETH. So that would be 45K. So highest bid is 45K. And then we use 40K to repay the debt. We take the 10K out of the reserve and burn that as well. So the whole debt of 50K is eliminated, and we are left with 5K. Of these 5,000, some of it goes to the system as a profit, and some of it goes as a reward to the challenger. And in this case, the challenger would get a 900. He always gets 2% of the highest bid. So if the highest bid is 45K, 2% of that is 900. That leaves 4,100 that goes to the system as a profit.
So challenger gets 2% of the 50,000 or the 45,000 highest bid.
Exactly.
So then, yeah.
So this is the reward for a challenger. I think it's quite a nice reward. You can earn a 2% return on whatever you provide as a collateral within 2 days.
Cool. Yeah.
So this is the good case. So there's also a bad case. Let's say the highest bid is only 30K. So this is horrible. In this case, the challenger would still get his reward because a successful challenge is a successful challenge. In this case, the reward would only be 600. And the remaining part is not enough to repay all the 50K. So out of the 30, so there's now 29,400 left. We add the 10K reserve, it's 39,400. And now it's 10,600 that's missing. And these 10,600, they are provided by the system. So it means the system incurs a loss. So the system loses something. And we will get to what that means. So does the system have some balance, a reserve, and it's essentially, it will boil down to that the system is a little like a bank with equity capital, and these profits and losses, they accumulate. And of course, if there are more losses than profits, then at some point the system will go bankrupt. But hopefully the parameters are nicely designed that at average there will be liquidation gains and profits. I stopped hearing you.
Okay, I turned off my mic. Can you hear me?
Yes.
Well, I'm guessing this is similar to like a maker where then you would be minting your governance token and selling it off to cover the losses.
Actually, no. So there is a governance token that is being sold to refill equity capital, but we do that in advance. So in the Frankencoin system, it's a little like if it was a bank. So I keep comparing it to a bank because it's a bank without a bank. It's like a listed bank where at any time you can buy governance tokens that are freshly minted, and whatever you pay for these tokens goes into the reserve. This is basically the equity capital. And of course, if those who hold the governance tokens make sure that the system is well maintained and there's no crazy borrowing, it's all sustainable, then the system works very well, because then there will always be enough reserves to cover these losses, and there over time there will be more profits than losses.
So this would be like so do you put it in here like, do you have an auction once a week or something like that?
It's so this the governance token, or yes. So the governance token is an ERC20 token on its own, and here I use another thing that I developed as part of my pending PhD, which is a concept I call the continuous capital corporation.
Yes, the CCC.
Yes. And what it does is so I derive an equation which I show to work under quite a wide range of circumstances to be economically optimal. And using that equation, we can issue and redeem governance tokens at any time. So you can go there and say, I want to put in 10,000 Frankencoin, give me some governance token, and then this it's a little like an automated market maker. This automated market maker prints some governance tokens for you, and you get them. And someone else might then come and say, I sell the same amount of tokens that you just bought, and then they will get these 10,000 Frankencoins. So it's path independent, like usual, and it also has a small fee to discourage small scale arbitrage, and that's the governance token.
Yeah, no, I like it. And then the governance token, I guess, what do you get as the governance token? Do you get this 2% fee then?
Yes.
Yep.
For example, this goes into the equity capital, which belongs to all governance token holders collectively. And this automated market making mechanism knows how much equity capital there is. So whenever there's a fee flowing in, it adjusts the price upwards a little. And when there's a loss, it adjusts the price downwards. And
so the price isn't, the price is based upon the equity capital to.
Exactly.
So if a loss comes in and the equity capital goes down, now you can go buy governance tokens cheaper.
Exactly.
Yep. And so you would hope that it would stabilize itself.
Yes. And of course, there's a big risk of front running here. So if there is a big loss happening, then some people might sell immediately for it and buy back a little after it. And this risk is addressed by having a small fee, which makes sure it's not as dramatic when it can't be done for small scale losses and profits. But if there's a really big one, then this is one of the weaknesses of the system that we accept. There could be front running, and someone might extract some value out of the system when they foresee the liquidation.
Yep. Yeah. Well, I mean, I feel like that's a lot of liquidations.
Yes. Yeah, and the larger the system is, the harder it is to exploit it, because then an individual liquidation isn't that important anymore.
Right.
It makes a small relative difference.
Cool.
Yes. So this only leaves one important element, and this is the voting mechanism. So most protocols like Maker or Uniswap or so that have a governance token, they have some kind of voting mechanism. And I also didn't like those very much, because it's a voting on chain is very heavyweight. And typically there's only a handful of active participants. So it's not very decentralized. So I replaced the votes with vetoes. Instead of a democratic vote, there's veto power, and you gain veto power already with 2% of the votes. So if you have 2% of the governance token, you can gain veto power. So there's one small twist I can maybe cover later, is that it also, your votes depend on for how long you held your governance token. So this is against flash loans. But let's say you have 2% of the voting power, then you can veto any new proposal. So if someone proposes a new collateral and you think the collateral is fine, but the interest is way too low, or the fee is too low, or I don't like the price, that liquidation price that is set, then you can veto that. And you can.
So when you're setting up an asset, you have to set the reserve requirement and the interest rate for the whole asset. So like all positions will have the same one.
Yes, of course you can have different. You can create a new configuration for the same asset again.
Right.
But if there is one that is established, others can copy from that, which is a much more lightweight process than coming up with the whole set of parameters from the start.
Right.
So and if someone proposes a new collateral or an old collateral with completely new parameters, then there's this application period, maybe 3 days, maybe 10 days. This is also something you can propose, but it needs to be at least 3 days. Then during that period, it can be vetoed. And if there's a veto, it's declined.
And then what other power do you have versus voting on that?
You can also veto new minters. So this is a very fundamental part of the system. So
you have, this is a whitelisted role?
No. Anyone can propose a new collateral or a new minting mechanism.
Okay, but you could veto it if you don't like them.
Exactly.
Cool.
And when you propose something, there's also a fee attached to that, so you cannot spam the system. So every time you make a proposal, it's 1,000 Frankencoin.
So and why would you want to veto new minters if you already have the veto power for new collateral types?
So a new minter is a much more fundamental change. So this is when you say we want to introduce a completely new way of doing auctions, a completely new way of minting Frankencoins. This is
okay. Yeah.
This is a very large scale change that should happen very rarely. So this is
so a new minter isn't like this person. A new minter is like this whole methodology.
Exactly.
It's like a modular contract that you could change.
Exactly. So this is a very fundamental thing that should almost never happen.
Yeah.
But what frequently would happen is the new type of collateral, and there we need something that is more lightweight than the voting, and this is the veto. So veto is much more lightweight. There's one person who can do it, and it's done. It's not a lengthy process.
Well, and then this is it's 3 days, right?
At least 3 days, yes, for the new collateral.
Yeah. Okay. And then how long If you're just opening up a new position on previously done collateral, is that instant?
Yes, if you
Okay.
don't change, so you can also change a little. You can always lower the liquidation price.
Okay.
But if you increase the liquidation price, then it can become subject to a, so in that case, it's not even a veto that can be cast, but there's a period where you cannot mint yet, but others can challenge it. Let's say someone increases the liquidation price to 5,000, then they're not allowed to mint based on that price for a certain period. So the challengers get a chance to step in and say 5,000 is way too high. And then there's the
How long
ordinary
would that be? Like
liquidation.
a day or?
I think it's all, I'm not sure by heart. It's also in that order of magnitude, a day or two.
Okay.
So
No, I love this system because
yes.
everything's like I feel like a lot of people in DeFi move towards like everything has to be, you know, like the next block and crazy fast. And you're like,
No, it should be
no, just
slow.
make them wait a day.
Yes,
We're gonna do a
and
day-long Dutch auction.
the system is not designed to be fast. It's very slow liquidations. So maybe it's also not the best system. So if you want to have capital efficiency, you can use Curve, US dollar, liquidity, and so on. But there you're very limited with the collateral. In this system, you could put in there anything that is somewhat available on the market. You cannot use NFTs because they're unique, so the auction mechanism wouldn't work. But maybe you want to, you have a company that you tokenized and its shares are somewhat publicly traded on Uniswap, but not very liquid. And in that case, you might be able to use your shares of your company as a collateral to mint new Frankencoins. And then
Right.
the liquidation period might be a week or so, because for someone to challenge it, it takes quite a while to maybe obtain some of these shares, maybe to analyze the company to figure out what's the true value. And that makes the system a little different. It's slower and more versatile. And it's also suitable for less liquid collateral.
Well, I mean, the problem with less liquid collateral, you would assume is like, you know, because like I would assume like part of the problem with like for, you know, like we have a token, like I run Teller, like an Oracle, you know, like you could theoretically see smaller teams say like, hey, can we use our little tiny token in your system? Like we promise we'll put up like, you know, 50% reserve requirement and whatever else because we have a boatload of it. The risk is that basically like if you allow in one bad token and they rug you guys, it would like affect you. They could drain the whole equity capital, right?
So each token also comes with a limit. So when you
Okay.
add a new token, you say this is the same also with DAI. If there's a type of
Yep.
collateral, then there's a limit for how much can be minted with that collateral. And of course, so what needs to develop over time is some community standards. What's an acceptable collateral and what are the right acceptable parameters for that collateral?
Yeah, and then I mean like the other risk too, I guess, like if you had say a token with less liquidity in there, you know, if there's less liquidity on here, you would assume that like if there isn't a Uniswap pool that you can instantly trade it on, you would assume that the Dutch auction might not properly reflect the price. Like there might be a big discount at which
That
the
also
system.
means there's more to gain for those who participate.
Sure. But it would basically be, if there is any sort of inefficiency there, it would be eaten by the system in some way. And
Yes.
is it safe to say that the I guess, yeah. But basically the total amount of Frankencoins issued should always just equal the deposited collateral, and then the equity capital you can think of as like the backup reserves for in case everything sort of.
So I have a sketch of a few of a small stylistic balance sheet of that. So it's the collateral, of course, should always be much more valuable than the Frankencoins in circulation.
Yep.
And
I mean, what do you think is the target? Because I know a lot of people talk like about collateralization ratios. What do you think this system could ideally achieve? You know, like could it be 120% collateralized, 110?
I would go higher. So this system is not designed for capital efficiency.
Okay.
This is designed for so to feel safe, I would start with 200 or so.
200 or so. All right.
Yeah, so it's, of course, there's those who seek the high, who always want to go to maximum leverage and so on. But in practice, many investors, they don't feel comfortable with 100% coverage. It means the price has to drop by 20% and then they're already liquidated. So this is designed for the slower thinking, long-term, more conservative types of investors that also make. So the first asset I put into the system, so I deployed it on Sunday based on the results of the chain security audit. I felt comfortable deploying it. And the first collateral I added to the system is a coin called Real Unit, which is a security that tracks the value of the Swiss economy. So it's issued by a very conservative banker in Switzerland who says, I designed, and it's a regulated investment fund. And it's designed to track the value of the Swiss economy. So it started at 1 Swiss franc per coin a few years ago, and now it's at 106 because the Swiss economy has grown by 6% since then. Nice. So it just so this is not a crypto speculative object, but it's something with a very tangible value that so they have this net asset value statement where you can see that they invest in gold and some blue chip stocks. So it's not these bump and dump highly volatile crypto tokens I'm aiming at. It's more like those that have tangible value behind.
Nice. No, that's super cool. All right, so what am I missing in Frankencoin? So where's you know, I know you had talked a little bit about there's like long-term price stability versus short-term price stability in your white paper.
Yes.
You know,
yes,
like,
and this is one huge area that we didn't touch at all.
Yep.
Where does the price stability come from?
Yep.
At the moment, you have a nice system to liquidate and to mint, but it's at no point we built in a reference to the Swiss franc.
Right.
So why is it back to the Swiss franc, not the US dollar? So and actually this is a very soft peg. It's not a hard peg where so this is due to the lack of oracle. So it's kind of a soft market enforced peg. And so there's a small module that I added that adds kind of a hard peg, but this is something that is more like to get it going. I see this as a temporary measure to see how, if it's still, maybe it's not necessary anymore in the future, but it's and this hard peg thing is it's just I call it a stablecoin bridge, where you can put in an established Swiss franc stablecoin and you can mint Frankencoin against that. So this is good to establish the whole thing. But in the long run, there's an interesting financial theory that says if you have two assets that have the exact same return in an efficient market, they should also have the same price. So that means if those governing the system manage it in a way that in the long run, the interest that you can earn by investing these Frankencoins into the governance token is the same as the interest you would get by investing your money into Swiss franc government bonds or whatever the reference interest is. And then, of course, you need to adjust by a factor because of a different risk profile. But the theory says if you have the same risk-adjusted return in both and the same risk-adjusted yield, then they have the same price in an efficient market. And so that means if those governing the system or the governance token is called Frankencoin pool share. So if the pool shareholders collectively succeed in making sure that the interest rate is similar to that on the real Swiss franc, then the long-term value is also the same, and the fundamental value is the same. And the question is, why should they coordinate on that? And the answer is, it's just by convention and by knowing that the value of the system is the highest when it is the most reliable in tracking the reference currency. So it's just by convention that it tracks the Swiss franc, and those governing the system know that if they ensure that it keeps tracking the Swiss franc, their Frankencoin pool shares are the most valuable. And if there's a depeg event, of course, their shares drop in value because no one trusts the system anymore.
Yeah. Well, I mean, like most stable coins peg by, if the price of Frankencoins drops to say 99 cents, you would buy up a ton of stablecoin, but a ton of that stablecoin, pushing the market price back up to $1, and then go and liquidate it for some underlying collateral. That obviously doesn't work here, because you wouldn't. There's no way to liquidate this unless it's underpriced. So, you know, you would basically just, it would have to be like, you would assume over the long run that it would, obviously, like if the price of Frankencoin rises, so there would be a cap kind of at the, you know, $1 mark or something like that, especially if you have the stablecoin peg, because if Frankencoins are worth $1 or something like that in Swiss francs, then you would buy the stablecoin and mint a bunch of Frankencoins.
Exactly,
you know,
exactly.
Minus the fee, but yeah. So I think, did I summarize that correctly?
Yes. So this is well
Okay.
summarized, and it means that I wouldn't expect it to be as stable as the curve US dollar, for example, because it's a long-term peg, and it relies on market forces to recognize the fundamental value and to push it towards the fundamental value. And this is probably one of the weaknesses of the system, but it's given that I'd like to appeal to a long-term oriented user base, it shouldn't be as much of an issue as it is with someone who needs to liquidate high volumes at the short run. So that's
sure. Yeah, and then, you know, we can talk about risks. Obviously, the big risk here is like the collateral price moving too much on you. So that this would be like what happened in like what is it? Not Tether, Luna. So in the Luna collapse, basically, it was collateralized.
I wouldn't want to compare it to Luna at all. So Luna was not truly collateralized. Of course, they had some USDC reserves, but this was not. So if you want to have something that is credibly stable, you need to have over collateralization.
But the risk here would be like in a similar, your system is not like Luna, but if I was to like try and draw it out, it would be like if the ETH price shoots up to $500,000 per Frankencoin, and then you mint a whole bunch of Frankencoins, and then ETH drops from $500,000 back down to 50, then the entire system's uncollateralized.
Yes.
And
so
everyone
then there's a problem.
For sure.
And and so that there's different safeguards. So one is, of course, this reserve, these 20%. Then there's the equity capital, and then there's actually a third line of defense. So if the equity capital goes to zero, we start using the reserves of the other borrowers. So if there's 10 different borrowers with 10 different collaterals, and one of the collateral fails catastrophically and wipes out all equity capital holder, this would by the way also wipes out the shareholders, and you can, it's like a recapitalization, a little like a bankruptcy in real life, where someone new might step in and get all the newly minted pool shares, and the former shareholders are eliminated. And
this would be like if somebody's mortgage goes bad and the bank is at risk,
then
they're going to liquidate my mortgage.
Yes, and this is the case where the bank goes bankrupt. and the shareholders they lose all their investment, and there's a function called restructure cap table that's for this scenario, and then a new shareholder could step in and say, I provide some initial capital again and get the system going. And what's also used in such a catastrophic scenario, after equity holders are wiped out, it starts using the reserves. So these $10,000 from the example, if that was your position and someone else was liquidated and there was a catastrophic failure, some of that 10,000 might be used to cover the loss.
Nice.
And this, of course, this is very harsh. This is like your bank goes bankrupt and then part of your house is sold to cover the losses of a bank because you had a mortgage there. So it doesn't exist in the real world, but here it just adds an additional layer, and it also provides an incentive for the borrowers to watch each other. So if you are a large-scale borrower here who put up a lot of collateral, you probably would also want to become a shareholder and veto the borrowers that are not so well collateralized.
Nice. Well, and then I think it also sort of incentivizes you almost want a lot of different collateral types then that are sort of uncorrelated.
Exactly. That would be the goal. So it wouldn't be good to have just ETH and staked ETH and maybe Bitcoin. It's all too heavy. Even so, the tech stocks are heavily correlated with Bitcoin. So it's yes. That's why a coin like Real Unit is a good candidate, which has a very good track record at being boring and stable.
No, that's super cool. And then
so yes, if you want to look into what are attack vectors, so one in this system, of course, is if you want to build a competing system, you could say, I just buy 2% of the votes and then I veto everything, so the system is
frozen,
cannot grow anymore, and then I build my new system with different parameters and everyone needs to use my system. So to guard against malicious minority, there's a function to the function is called kamikaze, so it's to kill the votes of others. So if I have 500 votes and you have 700 votes, I can use my 500 votes to reduce your votes to 200.
Nice.
So that if there's a malicious minority, it can be neutralized by an altruistic shareholder that thinks this minority is blocking all the progress. And then I formally show in my PhD thesis that this boils down to a majority vote. So in the end, if there's a total war between all the shareholders about some issue, in the end, it boils down to the majority winning. And if you have 50.1% of the votes, you can, of course, you can cancel all the other votes, and then you have enough to bring through your proposal. And if you have 49.9, then it's not enough in this total war scenario. So it's actually a very efficient way of governance, because it's in the good case, which is 99% of the time, it's very lean. You can just veto whatever makes no sense. And in the bad case, when there's a bad actor that maliciously tries to veto things that are actually good, then you can escalate and make things good again.
Right. Yeah, I mean, it is, I guess the trade-off here, so like you don't have the Oracle external dependency, but you almost have like an external dependency on the governance.
Yes.
You're hoping that whoever these governance people are paying attention to the system and protecting you.
Yes.
Whereas in Liquidity, there is none of that governance risk, but you hope that the Oracle is protecting you. So it's like internalizing it in some ways.
Yes. So in that way, it's more dependent on some outside forces than Liquidity. So it sets up the economic incentives to say, look, here is a system that should work, and you have an incentive to make sure it works, but it still requires some attention by someone. And what I don't have a mechanism against free riders. Maybe you just buy the shares and you're a passive investor and you don't watch the system, and then you rely on others voting for you and doing the work for you. But this also happens in a normal stock market. So most shareholders are very passive and they rely on a few active ones to use their votes to impose their economic interest.
Nice. Yeah. No, it's a problem that's hard. And then I mean the other thing I was thinking about is you have, you know, like I know some people have done Dutch auctions in the past, but a lot of times getting liquid interest, you know, like a lot of interest in Dutch auctions can be hard, especially when they're very infrequent. You know, like like how do you think of that? Because like theoretically, like if you only have a few, since everything's super correlated, if all the liquidations happen at once, you're gonna need, you know, like you're gonna need a whole bunch of people to post challenges. So then like you're gonna need a lot of money there, and then you're also gonna need a whole lot of people willing to bid on this stuff to kind of protect the system. So you would almost need like hopefully somebody's sitting off on the side with a bunch of cash, right?
Yes. So it's yes, this is it locks up some collateral. Of course, you can reuse it once the auction is over, but it means it takes a lot of time until everything went through.
Yeah, yeah, but I mean, kudos to you. Like I love the fact that you're like willing, like, oh, it's gonna take 2 days. Like that's, you know, like, people can go get more cash. Whereas, you know, a lot of systems, it's like you have an hour, and it's like for a Dutch auction, and it's very, very insecure. So no, this is cool. And then I mean, random question: Are you an economist or a computer science guy by training?
Both. So I started as a computer science with a computer science degree from ETH in Zurich, and then later in life I also got a master's degree in economics. So and this is very convenient in the blockchain space because there's always a cocktail of economic and computer science problems.
Yeah, well, I mean, even just hearing you talk about, you know, how banks work and things like that, it sounds like you came at it from a very economic standpoint, which is cool. And then, yeah, I guess as building, you know, as we kind of wrap up on an hour, you know, like as you were building this stablecoin, you know, like what sort of, how has your view of stablecoins and the future of stablecoins kind of changed over the past year?
So I believe that they could have a tremendous impact and they could kind of democratize banking if you have this. So they could take over the role of the money multiplier in the economy. So this is a very important variable. And this, of course, something that would concern the central banks if they don't have direct control over the money multiplier anymore. And this is also a very political topic because through the capital requirements, so there's two ways that the central banks and the regulators can direct the money flows. One is the interest rate. This is very well known. The higher interest rate means less investments, lower interest rate means more investments. But they can also choose which kind of investments are being made by allowing the banks to print money for one purpose, but not for another. And for typically, they allow banks to print tons of money for buying government bonds and for doing real estate, for mortgages. Right. Because there the capital requirements are relatively low. So the ECB even, I'm not sure if that's still in place, but they even at some point said the capital requirements when you buy European government bonds are 0. So you can leverage infinitely. And then, of course, if you have...
Well, rates were negative, to be fair.
Yeah, but even so, if you have a rate of 0.5% and you can leverage infinitely, that becomes more attractive than a real world project with a yield of 20%.
Completely agree.
And this is where they distort the economy through the capital requirements. It would be much more in the interest of society to have that money flow into the 20% return project, because then you grow the economy at 20%. And but instead they're putting into the highly leveraged government bonds, and this is not so healthy. But of course, it's in the interest of the government because that allows them to finance wars in the case of the US, maybe in Europe it's mostly social security, and I think this is it starts as a technical and small scale economic problem, but it's a fundamental question about the role of the government and the individual. How strong should the role of the government be in planning our economy, and how much should we give to the free forces of the market? And I'm of course in the second camp. I think at the moment the government has too much influence in steering the economy, and this is an old wisdom of economics that central planning doesn't work, because it's very hard to gather all the information in one place and then process it and take the right measures. This is has failed again and again. So I'm in the decentralized camp and try to create something that realizes that vision.
Yeah, well, I mean, like this, I like your idea of using like a bunch of different collaterals, because like, you know, on the interest rate piece, like, I argue with people that, you know, this is sort of a form of like, it could lead to like almost like hyper financialization in some ways, where like you could print money using anything as a collateral theoretically.
Yes,
off of this.
So this is just my pet project, and I'm not sure where it is going, because to make this big, it would probably need to someone to step in and say, I push this forward a little more. Two other roles I have is I'm involved with Bitcoin Swiss, the largest Swiss Bitcoin program. The other is Aktionariat, where we tokenize the shares of Swiss companies. And one company we recently tokenized is called Alan Frey AG. So this is a one-man company. He basically tokenized himself and said, I'm an influencer. I have the ambition to be a very recognized influencer. He already has a lot of recognition in Switzerland. He found a way to participate in the Winter Olympics as a project, and to use that and as a nice podcast and so on. And now you can buy his shares. So you can buy shares of his company that basically represents himself, and you can basically invest in that person. And that's an interesting way to tokenize an influencer. And then these tokens, of course, could also serve as a collateral in our system. So you could do what you just mentioned. You could leverage yourself.
Oh, I mean, well, but like, what does that say for interest rates in the long term? Like, if like this basically makes money free. Like if you know what I mean? Like you can borrow money always at a really, really low rate, because you can.
Not necessarily, because the system only works when it's in balance. So whenever you mint these coins, someone needs to buy them. You need to find a buyer. And the buyer will only be there if they can earn a reasonable interest rate. At the moment, the way to earn something is to put this money into the government tokens. Maybe in the future, through the Minter plugin adaptability, we could add a savings account. So maybe you can put in your money into that account and you earn interest on it. So that it's conceivable that there's all kind of ways that you could earn interest on Frankencoins besides the already existing, so the governance token. And this interest needs to be attractive enough for the buyer to buy the tokens. And
well, could you not use Frankencoin as a monetary coin?
Yes, of course. And this is the hope. So everyone wins if this is used as a transactional currency. So if it is used for everyday transactions, where people don't care about the interest, then everyone wins, and you get all these seigniorage gains.
Yep.
But still, there needs to be demand for that. And if the demand is too low, then interest rates will be higher to discourage too much lending. And if the demand for the transactional currency is very high, then the system can afford lower interest rates, because it's financed basically by those who use it as a payment currency.
Well, I mean, that's the problem with stable coins currently in DeFi. They're basically, nobody actually uses them transactionally. They're you know, the vast majority of stable coins, maybe besides like USDC or sometimes Tether, are just like interest-bearing assets in a lot of ways.
Yes, and this is a very hard challenge to use them more for transactions, because it's technically still not as convenient as using a credit card. And legally, there's a lot of hoops that you have to jump through if you want to do that at the larger scale.
We'll get there.
I'm not sure how long it takes, but I hope we will get there.
Yeah. Anyway, this was a blast. I could talk economics and we can do monetary policy at a different discussion. It'll be fun. But where can people find out more? Where can they look up your project?
So there's a website called Frankencoin.com, and at the bottom it has links to documentation, to GitHub, to all the source code, to the audit reports, and so on. And it's a front end to interact with the contracts that are deployed, so you can go there and try it out. It's very fresh, so it should be good because we had all the audits, but the front end might be not 100%. So don't rely 100% on the front end yet, but the back end should be, the smart contract should be quite robust and audited.
Is it live on mainnet?
Yes.
Yeah. So, and you want to get in early because now it's cheap to mint governance tokens.
Exactly.
So, yes, go get in. Anyway, but thank you so much. This was awesome.
Great. Thank you so much.